Thank you for watching Edupedia World videos. In this session, we will learn about inventory systems and valuation methods. When you set up SAP Business One, you need to define how to control the inventory valuation according to the business needs and the local legal settings. You have two choices for defining inventory valuation: a perpetual inventory system or a non-perpetual inventory system. A perpetual inventory system reflects the value of inventory posting in the terms of monetary transaction in the accounting system. These monetary transactions are carried out when the items defined as inventory items are received or are released from the stock. In a perpetual inventory system, the inventory transaction affects both stock level and stock value. Continuing with our inventory system, we also need to know this thing that automatic general entries for the change in stock value are created in general ledger. In our understanding the business example, we will work with a perpetual inventory system, so that this is what you will see in the demonstration and in the exercises later on. The other choice is to use non-perpetual inventory systems, in which sales, purchasing, and inventory and production transaction automatically create inventory transaction, which will affect only the inventory levels and have no effect on the stock value. So the transaction in a perpetual inventory system do not generate automatic inventory related monetary entries directly into the general ledger. Let us continue and understand about the setup for perpetual inventory. If you choose to use perpetual inventory, you need to make the configuration settings during the basic initialization before posting any transaction. To activate perpetual inventory, you can select the checkbox on the basic initialization tab of the company details window, which you will again find in the administration module. This transaction is under system initialization in administration module. You can then select to have a default valuation method for your company. This default will be used whenever you create a new item group. You can of course change the default in the item group or any item assigned to the item group. You have the option to manage the item costs separately for each warehouse rather than the setting an item cost at the company level. But once you have activated the perpetual inventory, each transaction that receives or issues inventory items is reflected in the inventory related GL accounts. After the first inventory transaction is posted, the option to choose either perpetual or non-perpetual inventory is disabled and its status cannot be changed anyhow. Continuing to understand monetary value of posting inventory. Assuming that you receive a quantity of Y items in your inventory and before you had X item or X quantity, so the inventory account balance will increase by Y. So as you purchase an inventory item, balance of the inventory account increases. Before GRPO, inventory balance was X quantity, and when you receive the item of Y quantity, the inventory volume increases by Y. Now, when you deliver some of the quantities from Y plus X, here is what you get. So when you sell this item and deliver it to a customer, the balance of the inventory account decreases. So we see that the values increase as the stock quantity grows, that is Y plus X, and value decrease as the stock quantity shrinks, that is Y plus X minus Z. The value of an item received in the inventory is based on either a purchase price or a fixed value. But how do we determine the value of the item when it is issued? To understand this thing, we have inventory valuation method. What is inventory valuation method? Inventory valuation is the cost of unsold goods in the company's inventory. It includes all costs incurred to get the item ready for sale, like material expenses, direct labor, freight, handling, import duties, etc. Inventory is an important asset of the company's balance sheet for small and medium businesses. So it is very important to calculate correct inventory value. There are several valuation methods, but for small businesses, it is generally restricted to FIFO and moving average. In SAP Business One, though, we have three: moving average, standard, and FIFO. SAP Business One provides these three valuation methods. Valuation methods are basically the formula for how you determine the cost of the units that you sell. These formulas can control inventory cost of an item if you are using perpetual inventory. If you are using perpetual inventory, you choose one of these three methods. We will see these methods one by one with examples. Let us understand first moving average inventory method or valuation method. Under the moving average inventory method, the average cost of each item stock or each item in the stock is recalculated after every inventory purchase. The calculation is the total cost of the items purchased divided by the number of items in the stock. The cost of the ending inventory and the cost of the goods sold are then set as this average cost. This is very different from FIFO or LIFO, which stands as first in, first out and last in, first out. Let us understand by an example. Assuming that the ABC International has 1032 GB pen drive in stock as of the beginning of April at a cost of per unit of $5. Thus the beginning inventory of the balance of 32 GB pen drive in the April is $5,000. Then the company purchases another 250 additional pen drives on April 10th for $6. So the total purchase will be of $1,500, and then again of 750 worth quantity on April 20 of $7 each. This leads to total purchase of $5,250. In the absence of any sales, this means that the moving average cost per unit at the end of April would be $5.88, which is calculated as $11,750. That is the sum of all the three amounts divided by the total quantity of the 32 GB pen drive, which will give us $5.88. Thus the moving average cost of 32 GB pen drive was $5 per unit at the beginning of the month and $5.88 at the end of the month. We will see another example and include some of the sales example also. Continuing our example 2, let us again assume that the ABC International has 1032 GB pen drive in the stock as of beginning of April at the cost of $5. It sells 250 of these units on April 5th and records a change to the goods sold of $1,250, which is calculated at 250 units into $5 per unit. This means that there are now 750 remaining in the stock at the same cost of $5, which has a total cost of $3,750. Then assuming that it purchases additional 250 quantity of pen drive on April 10th for the amount of $6, which amounts equal to $1,500. The moving average cost is now $5.25, which is again calculated as total cost of $5,250 divided by the 1000 units still on hand. ABC then sells another 200 units on April 12th and records a change of cost of goods sold of $1,050, which is calculated at 200 units into $5.25 that we got earlier. This means that now there are 800 units remaining in the stock at the cost of $5.25 and the total cost of $4,200. Finally, the company buys again 750 of these pen drives on April 20 for an each unit price of $7, which amounts to the total of $5,250. So at the end of the month, the moving average cost per unit would be $6.10, which is calculated as total cost 4,200 plus 500 $250 divided by the total remaining amount of 800 plus 750. Thus, in this second example, the company begins the month with $5,000 beginning balance of 32 GB pen drive, which was purchased at a cost of $5, sells 250 on April 5th, revises its unit cost to $5.25, and then ending up to $6.10 at April 20. Next is FIFO, or first in first out. In FIFO, it is assumed that in a warehouse, items that arrive first are sold first. Hence, it is calculated by summing the actual cost of the stock of an item available in the warehouse. Let us understand by an example. We have dates, transaction, quantities, and unit cost. So on 1st of January 2012, we purchase 10 of any amount of any item A with a unit cost of $12. On 3rd of January 2012, we purchase another 5 with a unit cost of 15. On 10th of January 2012, we sell them. Quantity is 12, but what is the unit cost? So to understand, let us understand what was the unit cost on 3rd of the January. The stock value as per FIFO would be 10, that is quantity, into 12, that is unit cost, plus 5, that is quantity again, into 15, that is unit cost, equal to $195. On 10, when it is sold with a quantity of 12, as per the FIFO, 10 quantity at the rate of $12 and 2 quantities at the rate of $15 will be considered for sale. Stock value for remaining stock as per FIFO would be 3 into $15, that is $45. Continuing with FIFO, when you use this method, the system calculates the item cost as the cost of the oldest unit on hand. The first item received in the stocks are first item to be issued. This is a useful method if you have inventory items with expiration dates. You want to sell the items before the expiration date, so you always sell the oldest item first. But how does this method works? The system stores each good received in the inventory in a separate layer. That's why sometimes this relates to a layer in valuation method. When you post any good issue, such as when you sell an item, the system uses the price for the oldest layer from the second oldest and so on. Again, to end up FIFO, let us see an example. Let us say that you buy a quantity of 5 at $10 each. The unit cost of the first layer is $10. Then you buy a second quantity of 5 at $20 each. The oldest layer cost remains $10. However, you also now have a newer layer with an unit cost of $20. When you sell the item, the system uses the oldest layer first. So the first quantity of 5 sold has an item cost of $10. The last of the method is standard method. In standard evaluation method, you manually put the amount in the inventory tab of item master data in SAP Business One. We will also visit inventory tab in our part B of item master data. The system uses this price for all stock movements. This is a straight method to use for items which you manufacture in-house. Example would be you set the standard price at $10. Therefore, when an item is received into stock, it is valued at $10. When it is sold, the item cost remains $10. Setting a standard price will keep the price intact. You decide what item is worth and specify the unit cost. So if you buy this item, say for $11 next time, the $1 difference is posted in variance account. and the item cost remains $10. Somehow it is possible to adjust a standard price item cost through inventory revaluation on a periodic basis. Thank you.